Moving now to investing activities using the direct method. CFI, or cash flow from investing, is calculated by examining the changes in the gross asset account that results from investing activities. Typically, we are considering purchases or sale of equipment, i.e. long-term assets. The first thing we will look at is how to determine cash paid for new equipment. To do so, we must analyze whether old assets are sold or not. And here is the simple expression that you need to know. The cash paid for new equipment is equal to ending gross equipment balance plus gross cost of equipment sold minus beginning gross equipment balance. You need to make sure you understand what gross means. If you buy equipment for 100, and let's say this equipment will be used for 10 years and every year the depreciation is 10, then after 1 year, the net book value of the equipment will be 100 minus 10, assuming 10 is the depreciation every year. So you will have a book value of 90. After 2 years, you depreciate 10 again and you will have a net book value of 80. So the 80 is referred to as net book value. The gross equipment value is 80. The gross equipment value is still 100. So notice the gross value is the net value plus the accumulated depreciation. Accumulated depreciation in this example is 20. So cash paid for new equipment is ending gross equipment balance plus the gross cost of equipment sold minus beginning gross equipment balance. Let's say that we start with a simple example where nothing was sold during the year. If the ending gross equipment balance is 500 and the beginning gross equipment balance is equal to 400, then this obviously means that the cash paid for new equipment must be 100, assuming of course that nothing was sold during the year. You take the end number, subtract the beginning number, and the difference has to be explained by how much cash was paid for the new equipment. Now let's say from the footnotes you recognize that the gross cost of equipment sold was 50. Then what is the cash paid for new equipment? The answer then is as follows. You have an ending balance, let's say again of 500. So you will do 500 plus 50. The way you can think of this is if the equipment had not been sold, then the ending balance would have been 550. And then you subtract the beginning balance of 400. You have 550 minus 400, which is equal to 150. Next, we try to determine cash inflow from the sale of equipment. This is a little more complicated. And here we need to understand the equipment amount, the accumulated depreciation, and the gain or loss on sale of equipment. The cash from sale is equal to the historical cost of the equipment sold. This is the same as the gross cost of the equipment sold minus depreciation on equipment sold. When you combine these two items, you have the net book value of the equipment which is sold. Let's say that the net book value is equal to 80. And let's say that the gain on sale of equipment, which you can easily get from the income statement, is equal to 5. The cash from sale of the equipment would then clearly be 80 plus 5, which is 85. But these numbers, however, are not so easy to come up with. They are not given to you. They have to be computed using the financial statements. So let's see how we compute these numbers. The historical cost of equipment sold is equal to the beginning balance of equipment. So this would be the gross amount for equipment. if you are looking at a given time period, let's say 2010, you will look at the beginning balance of equipment. Then you will add the equipment purchased. This information would be obtained from footnotes. So you add that, and then you subtract the ending balance. You subtract the ending balance of equipment. And we look at an example on the next slide. Depreciation on equipment sold, that is given by this formula. The beginning balance of accumulated depreciation, again, that would be start of the period, plus depreciation expense minus ending balance of accumulated depreciation. These two items would come from the balance sheet. This would come from the income statement. And then you add the gain on sale of equipment. This is easy. This comes straight from the income statement. Now, I want you to memorize what you are looking at over here, or at least make a note and then attempt the question on the next slide, which is given right here. So here is what you should be doing. This is simply reproducing the information from the question. The correct answer is 3.5. You first compute the historical cost of equipment sold as 3. And to come up with 3, you need to look at the beginning balance of equipment. That's the gross amount, 80, plus equipment purchased, that's 14, minus ending balance, which is 91. And then you subtract the depreciation on equipment sold, that's 1. And you get that using this expression, beginning balance accumulated depreciation, which is 25. Plus depreciation expense 7 minus accumulated depreciation at the end 31, so that should give you 1. And then gain on sale of equipment from the income statement is 1.5. Put these numbers together and you should get 3.5. Coming now to financing activities, and as I mentioned before, both with investing activities and financing activities, we only have the direct method. There is no indirect method. Financing activities deals with cash flow between the firm and suppliers of capital. The major suppliers of capital are either lenders or bondholders and shareholders, be they common shareholders or preferred shareholders. So all this cash flow needs to be shown on the financing segment of the cash flow statement. It's referred to as the CFF, cash flow from financing. If you look at the lender side, the net cash flow from creditors is equal to the net borrowing. So in a given period, this would be the net borrowing. This is how much money the firm is getting from the lenders, minus the principal amounts repaid. And these are the principal amounts repaid. In this particular scenario, we are assuming that any interest paid is shown on the CFO part of the cash flow statement. So this clearly is a US GAAP perspective, or it could also be IFRS, where we are assuming that interest is shown in the CFO segment. In terms of interaction with shareholders, the net cash flow from shareholders is equal to new equity issued. When a firm issues new equity, it is going to get cash from shareholders. So that's this over here. Minus shares repurchased. When the firm repurchases shares, it is giving money to shareholders. And then also minus any cash dividends. When cash dividends are paid, there again the firm is giving cash to shareholders. The combination of these two essentially form the CFF part of the cash flow statement. Putting all this together, you notice that we have operating activities shown right up front, and we have discussed each of these elements: cash flow from customers, and then various cash expenses such as cash paid for rent, employees, etc. Then we have investing activities, where primarily we are dealing with the purchase and sale of equipment. Even investment securities would fall in this category. So this is CFI. And then financing activities, issues of stock, increases in notes payable, that means borrowing went up, repurchase of treasury stock, this is money going out to the shareholders, cash flow from financing activities, net amount is given right here. You add all these together and that's the total cash flow. This then is a simple example of a overall cash flow statement using the direct method. With the indirect method, the only thing that would be different would be the operating segment, where we would start with the net income and reconcile down to CFO. The CFO number would be the same. Let's briefly talk about the indirect method now. Here we begin with the net income, and this comes obviously straight from the income statement. Then we add back all non-cash charges to income and subtract all non-cash components of revenue. The classic example here would be depreciation for non-cash charges. Say for a given company, the net income is 100. Since we are dealing with cash flow, we need to add back depreciation. Say the depreciation charge is 10. Remember, the depreciation was subtracted in order to come up with net income. So if we are going to arrive at a CFO number, we need to add back depreciation. We subtract gains or losses that resulted from financing or investing activities. So actually subtract gains or add the losses that resulted from financing or investing activities. The classic example would be, let's say that on the income statement we showed a gain of 5 from the sale of equipment. Now the gain of 5 caused the net income to be higher, but that wasn't a real cash flow. That gain of 5 was not operating cash flow. So what we are then doing is subtracting that gain. If this had been a loss, then we would be adding. Then you add or subtract changes to balance sheet operating accounts. And we have discussed this before. Any increases in operating asset accounts, such as accounts receivable going up, is a use of cash. So that would be a minus. So if accounts receivable is going up by 3, then we would subtract 3. If inventory has gone up by 7, then we would subtract 7. Then we deal with increases in operating liability accounts. So if accounts payable is going up by 6, we would add 6 over here. Once you put all this together, you then have a reconciliation between net income and the cash flow from operations. In order to internalize what we are talking about over here, I'd strongly encourage you to do example 7 from the curriculum. Coming now to the conversion of cash flows from indirect to direct method. This is a little bit complicated, but it is part of the learning objectives. However, I think the probability of your being tested on this material in detail is low. Nevertheless, since it is part of the learning objectives, we will go over the process. Step 1 is to aggregate all revenues and expenses. So you come up with total revenues, subtract the total expenses, and you have your net income. This essentially is your income statement. Then you remove all non-cash items from aggregate revenues and expenses and break out remaining items into relevant cash flows. The major item here would be to take your revenue and remove non-cash revenue such as gain on sale of equipment. This material, by the way, is illustrated quite well in Exhibit 11 in the curriculum. So if you also follow along from the curriculum, this discussion will be a little bit easier. The cost of goods sold, salary and wages, etc., all this information you can get from the income statement. And then you convert accrual amounts. These are the amounts from the income statement which are based on accrual accounting. So you convert these accrual amounts to cash flow amounts by adjusting for working capital changes. The working capital is your accounts receivable, accounts payable, inventory, etc. Your current assets other than cash, and your current liabilities such as accounts payable. So when we talk about cash from customers, you start with the revenue number and make an adjustment based on accounts receivable. To get cash to suppliers, you start with COGS and make an adjustment based on changes in accounts payable and inventory, and so on. This is exactly what we have talked about earlier. So you make the adjustments and come up with the various cash payments, and then you have your final number for CFO. Notice we are only dealing with operating cash flows because for investing and financing, the material is always presented in the direct format anyway.